Welcome to our continuation of our Investor Studio series. This is Venture Capital for First-Time Founders. So this is Seminar 2 or Workshop 2, and we're thrilled to be talking about today VC 101, how venture capital funds work. So if you're coming here and those are new words to you, you're totally in the right place. If you're coming here and those are familiar words to you, you're also in the right place. So my name is Dr. Christine Galeb. I'm the Senior Director of Entrepreneurship and Innovation at the ION. And I just want to do a quick poll. Is this anyone's first time at the ION? Just raise your hand super high. That's awesome. Let's give a round of applause for those people that raised their hands. And if it's your second or third or fifth or 100th time at the ION, welcome back. We are so thankful that you're here. So tonight, what I would love to do is introduce the person who is actually sponsoring the drinks here at Second Draft a little later after our discussion today, and then he will introduce our speakers. So I'll call up Christopher Spears to the stage in just a second. He is the principal at BP Ventures. He is responsible for investment sourcing, execution, and portfolio company oversight. He focuses on transformational companies aligned with BP's ambitions in hydrogen, renewables, and bioenergy, as well as supporting BP Ventures portfolio companies through his board roles at Cold Bore Technologies and Syzygy Plasmodics. Does anyone know what Syzygy means? Just sidebar. You can just silently nod. It's like the coolest word in the whole bank of words. Chris is an ex-founder and joined BP Ventures in 2019 after starting his career working to bring stranded energy resources to market. He is personally inspired by the belief that innovation will be vital to solving the climate crisis and that viable business models exist outside of facilitating targeted advertisements. Chris holds a BS in Mechanical Engineering from the University of Florida and an MS in Management Science and Engineering from Stanford University. Chris was recognized as a Global Corporate Venturing Rising Star in 2022. So please join me in welcoming Christopher Spears to our stage.
Hey everybody, I'm Grace Chan from BP Ventures. Oh, no, sorry. Grace was supposed to be introducing Neil, but he kept telling her last week that she should quit, and now she stopped showing up to work, so you got me today. She didn't stop showing up, she's in the audience. I'm Chris Spears, thanks Christine. We're located upstairs across the hall from Neil. We don't have a sign in the office yet. But it is a very nice office. You should come by and say hi. We take pitches. I could come up here and tell you what BP does, but I think you guys know that. And really, this is about Neil and Andrew and their discussion. So we'll get the introduction on them. Neil Dykman is our host for a 4-part venture capital for first-time founders, Investor Studio series. Neil, that is an incredible amount of words for this series. You should compress that a bit. He's a self-proclaimed 7X co-founder of tech startups, which have gone on to raise over $500 million in capital with a number of exits and 2 IPOs. He's been a venture capitalist for almost 20 years in IT and energy, including at Jane Capital and Rolled Out Shell, and co-funded his latest fund, Energy Transition Ventures, in 2021, after taking a break to run for U.S. Senate as the 2018 Texas Libertarian Party nominee. ETV was the first venture fund to open their headquarters in the ION, and Neil here, as accurately mentioned, the BP Ventures does have more people here than ETV. His co-host is Andrew Nicholson, who is the managing director of Goose Capital, located downstairs here in the ION, and a reformed energy company geologist with lots of degrees from Rice and UT. Instead of a real school like Texas A&M, I'm not sure who that got in there. Goose is Houston's most exclusive angel network and has been leading seed deals for a couple of decades. Andrew's job is kind of front-running venture capitalists like Neil. This is a great script. Goose Capital is kind of famous for starting the trend of investing in startups at Rice Alliance, business plan competition in 72 hours, and having 25 and only 25 very rich angels from big Houston companies. With that, I'll hand it over to Neil and Andrew.
So you stuck to the script. Good job, Grace.
You told me this was scriptless.
I told you it was scriptless?
Neil,
I might have lied.
Yeah, we need to know our audience, so we have to ask them the first question. That's kind of the first
We
rule.
don't have to do that. Really? You want? Fine. Go ahead.
Yeah. Can I get are there any founders in the audience? Can you raise your hand? Oh, good. This is really good. That's why we're kind of doing this series. So it's very nice to see you. Anybody thinking about becoming a founder, just thinking of the idea? Wonderful. That's also why we're doing this series. Do you work for a startup? Are you in the ecosystem? I saw our ION colleagues. Excellent. And then anybody that's VC curious or actually in a VC, just want to learn? Not a VC, BP up front? Wonderful. Well, it's nice to have you.
So there's some goals with this program for those of you who were here last week and those who are going to come back next week and the week after. Yeah, Houston doesn't have enough founders. We're trying to mint more. So this is our snarky little talk, and we put it on videos. We can publish it and make our own marketing collateral on basically the process for founding and doing startups and stuff. I've done a bunch of them, and dawned on me a while back that the people that are upstairs actually working and present in the ION aren't necessarily on the stage talking to each other. They're asking people like me for answers, and they need to be talking to each other. So we need to fix that. So the first one talk last week was on how to do a startup, basically. It was a bit snarky. This one, well, next one is on how to raise money off of VC. VCs are very gameable. We try and be gamed on purpose. It's all good. The one after that is how not to screw up your company afterwards, the mistakes everybody makes after the Series A. This one is on how the venture fund works. And I asked Andrew to join and BP to help because they're actually here in the building. Andrew works under the stairs, like kind of like a hobbit hole thing.
I prefer
going on.
Harry Potter.
Harry Potter thing,
Thank you.
yes. Literally, he's down there taking pitches and writing checks. We work upstairs, right down the hall from the famous BP, who has the office that I used to go sit in when they were not there, but they have no sign. So you got to go knock on doors and find them. But part of the goal of the ION is to stop talking about an ecosystem. That's kind of dumb and stupid. The goal of the ION is to actually do it. Just start a company, run a company, raise some money, make some happy customers, and keep going. If you're going to raise money from VCs, you really need to understand how this world thinks. It's not like the Houston PE funds. It's not Wall Street. It's venture capital stuff. The venture capital world is a very tight world with a ton of unwritten rules. And the goal tonight is to unwrap a few of those unwritten rules, put new little bows on them so you know how to game VCs.
Neil, if I could jump in. Yeah, I mean, to me, the more we do this, the more we get together kind of thing and talk about it and bounce people off of each other and connections.
We're going to bounce people off each other, yeah.
The better your pitches will be when you go talk to VCs. You won't burn any of the hard-earned relationships you win over in pitch meetings you get. We don't want you to waste those. We want you to come in ready to go with your best foot forward. And it's kind of a flywheel effect, we hope.
Exactly. So first off, what is venture capital? I had a definition I wrote back in the day. Serial pooling of overlapping shared equity risk capital in 2-year tranches to enable rapid development of massively parallel R&D and technology commercialization. This is not private equity. We don't want control of your damn company, right? We don't want to be the only check you raise. We're going to give you 2 years of cash shared with a couple other people. You're going to burn that money to get 2 more years of cash at a higher price as fast as you can with some of our money and some of the next people's money, and we're pooling and sharing risk, and you're supposed to go run the company and make us money. If I have to run your company, I'm just going to fire you or shut down the company. In reality, I'm probably not even going to fire you because then I got to run the company. I'll probably either just walk away, and that's okay. This is high growth, high risk, roller coaster fun. This is how to aggregate enough capital to take serious shots on goal. So inside our funds, I think the best way you should think about it is this is like elephant hunting with a shotgun and trying to hit gazelles in between the elephants. Okay?
Well,
Do you like that? Is that good?
It's the same.
They call them unicorns now, but back in the day we called them elephants.
It's
and
the same term
gazelles.
we use in the oil field, or we did. I'm a reformed oil field. Sorry. But yes, that is, we're not looking, you've used a baseball analogy, we're not looking for singles or doubles. You're looking
No,
for,
bad. No singles, doubles. Can't win in venture fund on singles and doubles.
You're not
in fact, I'm not even looking to manage risk. I am looking to take risk, right? Every fund has defined when it starts what type of risk it wants to take. And we very happily tell you exactly what risk we want to take. Do not come sell me a risk that I don't want. Do not tell me your deal is less risky because of X, Y. I don't care. That's bad. All that says is y'all don't know what you're doing. Come tell me, hey, I understand you want early stage, you want this kind of risk. I look like the risk you want. Come take some risk with me. This is why the bet is worth taking. Because if it's not risky, it's not venture capital.
To me, what you're saying is if the market's not big enough, if the prize isn't big enough on the uncertainty of the outcome, then it's not worth taking.
So
I actively try to de-risk things. I think you do too.
Andrew's an angel investor. His job is to front run the funds. Now, question. All right.
Yeah, let's talk about
what
the different types.
do you think the cost of capital is for a Series A startup?
Very high.
How high? Anybody got an answer? What do you think? 35? 45? Y'all ain't even close. If it's not 70, 80, 90, you're not even in the ballpark, right? Just imagine a world where 1 out of 10 deals is supposed to carry the fund. If one of my companies returns my whole fund, my fund probably does well. There's enough out of the others to double my money. If 2 of them do and 1 of them does even better, my fund does really well, right? To do that, if the rest of them aren't going to do so well, if you kind of look at that distribution curve of performance, or a bunch of them return their money, but that's it, effectively, every deal has got to be 60, 70, 80, 90% whack just to take the shot on goal. So if you go and sell me a 15% whack deal in a portfolio that's supposed to be taking a whole bunch of 75% whack risks, I mean, hello? And then you try and tell me, well, it's de-risked. Dude, I'm in the business of hunting 75% whack hyper-growth things.
Yeah, now while we're talking about WACC, we'll come back to it, but we don't want to confuse you with thinking about discounted cash flow models or anything like that in terms of valuation.
Yeah, we don't use discounted cash flow models.
We'll come back to that, but first let's talk about, what stage does Energy Transition Ventures play in?
So we're a classic fund. We're seed Series A, which is pretty much what everybody is. Back in the day, they said it was all Series A. Seed didn't exist. Now seed is the new Series A. So we've just shifted the nomenclature. But really, that's first professional institutional check-in.
We're the same. We typically play seed, but we also hit up into Series A. The names don't really mean anything. They're just
they're made up.
They're just about an order. You could call it, Series Elephant. It's just about an order of which the money comes in. And by the way, some companies have a seed A, B, C, down round. They just call everything a new B. And so you kind of, we know when there's been a down round.
What
we know
about
when there's been too much capital
A1
stacked
extension?
on. Say again?
A Series A1 extension.
That is a flat round or a minor up round.
Okay, look, so
Maybe.
let's, again, Andrew's not a fund. Andrew
Correct.
sits over there. He's got a bunch of really rich dudes. They all invest together, and they get deals done. Well, let's talk about a fund, what a fund is, right? There's 3 companies in the fund, right? There's the limited partnership, which writes you the checks, and the limited partners are all the rich people, the pension funds, the corporates, et cetera.
So you have a boss?
Yes, they're called limited partners and returns, right? So any given fund might have 1 limited partner, if BP wants to give me a dedicated private little fund to run, or it might have 20 to 100 of them, but it's not going to have much more than that, and usually it's a smallish number. So that's company 1. Company 2 is the general partner, the GP that runs the thing. And the classic model is they're a management company. GP got nothing in it, no people. All it does is sign for the fund. The management company has all the people. Management company gets paid because the GP lets them in a little contract 2% a year of the fund. And the GP gets 20-odd% of the profit after the capital is returned, usually with no hurdle. That's the standard 2 and 20.
Versus-
VC is that 3-company thing.
Versus, and what kind of, well, do you want to go into, I'm just thinking, so that's the model 2 and 20, and you guys are taking what kind of ownership in companies typically?
But that's a really
'Cause
good question.
I just want to contrast that with private equity, which,
Look, if you go kind of look at the stats on all the venture deals that do and kind of line them up, every round you sell 20, 30% of your company. Maybe you sell a third, maybe you sell 17. You almost never sell 40. You never sell control. You never sell 10 or 15. Ever. That's just a stupid deal.
in the early stages, you won't be selling away
the later
control.
stage, you might get down where you're only selling 5, 10% of the company a couple of rounds out. But in the early stage, the classic back in the day was Series A round, every investor wants 20%. You want a big enough stake to care. You don't want control. You want to have a 20% option plan. 20% for you leading, another 10 and change percent for a follow-on investor to a syndicate to share some risk with you. Management owns the rest. That's the deal. And now in Unicornlandia, that has shrunk a bit. So there'll be deals done where, the percentages are a bit lower. It's a bit of a problem because if you have a bunch of deals done and everybody's got 2, 3, 4, 5%, and there's 10 people that got 25%, there's nobody who cares about your company. Next round comes around, you're going to get screwed.
Yeah, I think we'll come back to, we're trying to paint the broader picture to then dissect each individual aspect at the different stages. But
All right, let's go through it. How many companies in a fund? Portfolio companies.
portfolio companies, it depends. Are you a concentrated fund where you're going for 10, or are you an N equals 50 type fund? And then how long do you have to deploy capital?
4 to 5 years.
So you need to do, if you're doing 40, if you have 4 years and 40 companies and you want to construct a portfolio of 40 companies.
Then if you're doing that, you need to get 10 deals a year done. That's a lot of deals.
Yeah.
Most venture funds probably more in the 15, 20 range. Yeah.
So if you're talking to somebody with a fund like that over a month or two and they haven't done your deal, they've probably announced another deal in that timeline. There's a velocity of capital that has to be deployed because of the LPA agreements.
Right.
That are
10-year
signed.
deal. It's like baseball, guaranteed contract, 10 years, couple year options on the back end, but it's only 4 or 5 years to invest.
Right. And how
in
much?
new companies.
So let's say you're a $50 million fund. You see that headline, somebody raises a $50 million fund. How much do they have to play with in those first 4 to 5 years?
So general model, right? 2% a year, 10 years, got 20% that's to run, it's the overhead.
Fees of the 2 and 20 model.
Exactly. That's the overhead, right? So that leaves you 80% to play with. And generally, well, just for grins, we'll call it 20 of that goes into deals. 20 of that is follow on into those same deals.
So in your scenario, for the $50 million fund, a 10-year fund with 2% management fee, you're looking at a 2, 2, and 1.
So if you want to do 10 deals, that's $2 million a deal, initial check. 20 deals, $1 million a deal, something on that order.
Yeah.
Right?
And correct. And now we've hit the crux of it for this stage. So you now want to construct a portfolio with 20 companies, and so you can write $1 million per initial check per company.
Well,
what stage do you have to play in?
Usually, most venture funds, they're not going to take 5% of a round, and they're not going to take all of a round. Though, we do invest by ourselves. So just imagine the prototypical deal is a 2 or 3-handed deal. And if I'm the lead investor, I want to have a third to half of that or more. If I'm follow on, I'm just throw $1 million in. So that $1 million is probably in rounds that average, $2 to $10 million.
Yeah,
Something on that order.
If you're writing $1 million check as a lead, the probably max round size that you're raising for that company is $4 million. Is the aggregate raise that you're putting the syndicate together for, because you're at least 25% of the deal. If you're less than 25% of the deal and you're leading it, red flags kind of go off to the other investors. You're like, why does this person get to set the price? Why do they get the board seat? Why are they setting the terms? What's special about them?
But I think there's one more thing we got to get out here. Like you're asking about who my boss was.
Yes.
I think you need to ask who the customer is.
Neil, who's your customer and who's the product?
The LPs are my customer. They're paying my salary. Startups, arguably more important than the customer, they're the product, really. So just think what you think about the model and just flip it, right? Because I'm going and selling limited partners. Hey, I'm going to go invest in the most awesome teams and most awesome startups. That's my product. That's what's on my shelf that I'm selling. The pipeline of you guys is literally what goes into my next pitch deck for my next LPs. Yeah. The quality of you, I put your little pictures in there, right? I put your bios in there. I talk about you. We had a quote I put on my LinkedIn a while back that you judge a cow by its calf and a venture capitalist by the founders.
True. I mean, the goal isn't to VCs at traditional funds are entrepreneurs too. They're going out with a literal pitch deck to LPs who are ultra high net worth individuals, endowments, pension funds, corporates,
all sorts of things.
They're out there just like you fundraising. And so if they raise their first fund, they're not trying to just do that one and probably go home.
Let's go back to the portfolio construction thing. We talked about this earlier, you and I, back in the Hobbit hole under the stairs. Sorry,
Harry Potter.
The Harry Potter
cupboard,
bedroom, cupboard, whatever. So I have seen plenty of funds that basically were in a bunch of exits. Oh, they got hits. And then the returns were just eh. Why were they eh? Because they were in great deals.
They paid too much money and put too little capital in.
They didn't have a
too high a price.
Big enough piece of the action, right? You put $1 million in, you quadrupled it, it's 4. You got a $50 or $100 million fund. What's that $3 million going to do you? I need to return 50 or 100. And so you'll see they'll have 4 or 5 just awesome exits. Like they picked stocks well, but they allocated their capital too little, too late to the ones that they picked well. Happens all the time.
All the time. 2021 and the first half of 2022 were anomalies. You can see all the data on PitchBook. The amount of capital going into venture deals from early stage to late stage was just anomalous. It has since fallen off of a cliff. Starting with the public markets, and then it's pushed its way into growth stage, and now it's coming.
What do public markets have to do with venture deals? We're getting to valuation now.
Well, it just goes back to rising inflation and rising costs of capital, and everybody's tightening their belts. And so, as an LP, do you want to give a VC principal, a general partner at a fund, more money after they just invested your money at such a high valuation? Now their mark to market they're underwater. There's no point in continuing the fund.
Well, they shouldn't have invested that high. Oh, but they only have 4 or 5 years to invest. So the vintage of when you start, you got to make some decisions. You're going to invest at pace? Are you going to go in really quickly? First fund gets set up. Usually there's some pent-up deals they've been working on in the miserable year it took them to raise their fund, and they go do 6 of them right then, and then settle down. But if you do a bunch of your capital allocation at a bad price in a bad vintage year, yeah, that can hurt. So they're going to be measured not against absolute returns, but also against, in 2021, how did all the other funds that started that year do?
Yeah, and if it's your first fund, you don't probably get to play the game again for a while. but you didn't deploy a lot of capital yet.
I have seen venture capitalists that I've seen fund numbers that were like zeros, not like, and they didn't make any profits, like they put out X and they returned X minus X, that still kept raising. It has happened.
Yeah,
probably shouldn't, but it has.
You want to talk about mark to market?
No.
How do you do it? I'm going to make
We're still early in our cycle. So look, VCs are supposed to value the companies in their portfolio at whatever they're worth right now. Well, how the hell am I going to know that?
Yeah, it's a pre-revenue company.
So it kind of sort of is cost plus some adjustments or the last round, but it's an art, not a science.
We take a conservative approach. We used last share price. It's actually the company went out to the market. Hopefully there was I don't actually want their, maybe I want there to be a competitive process. I just want them to get the funding. That's where the risk is at. So they raised the funding at somebody was willing to pay a certain price money in on a valuation, which translates to a share price. That's my last mark. On convertible notes, it's principal plus accrued interest. It's very conservative in my opinion. It's not based on multiple, like SaaS companies, a lot of times will be on multiples of revenue. Well, when the whole market was at paying forward 12 at like 60x revenue, you're like, I don't know how that math works.
Back in the day, all funds were done that way. Modern accounting has decided, no, we should make up a number, but a lot of us still use basically the same technique. Well, if I don't have a round to market against, like somebody paid this price for those shares, you're really careful to change that price. But of course, it gets sticky the other way in those down rounds.
Yep.
Then I got all these things up here. I look real good, except we all know that portfolio is overpriced.
Yeah.
So this is my life. It's like, what am I in for? What's my fund worth on the books now? And because I'm talking to my customers about that. So what y'all do in pulling off that funding round and running out of cash and revenues, it affects me like literally every day. I sit there and I obsess over it, trying to figure out, all right, where am I?
Yep. I think we're kind of, I don't know if you want to keep going on this. I think it's a really important topic, but entry point and valuation matter. They're when we come into a deal, it's all about valuation and terms. First, if we're even talking to you, it's because we probably like your idea. We want to see if we want to pick up that rock and turn it over. We like to look for the right people tackling the right idea at the right time. We want, okay, you're tackling some cool hot thing. We want the team that's going to win in that sector, in that specific thing. If it's an oligopoly type, if it's a winner take all, we want the team that's going to win. If it's multiple winners, we want one of the multiple winners. We don't want the company that's going to get halfway there and then fail.
Let's expand that point a second, because I get calls all the time. Hey, you're invested in an EV fast charging startup. Would you like to do another one? Like, no.
Yeah.
I invested, remember, we're making bets. Now, if you call and say, hey, you're invested in an EV fast charging startup, I have some stuff that is really complementary with it. You're going to like this store. Yeah, it means I like the area, but it doesn't mean I want to do something exactly like it.
That's right. And most likely we're seeing your pitch deck and we're going, that's interesting. And then you go to a board meeting and you talk to your company.
If I'm interested in you and I'm invested in the area, they're my first diligence call. Hey, I got this tech, this company call. Hey, it's pretty interesting. What do you know about it? Because I back them because they're the experts.
Right.
So back to the portfolio construction, we may have those 20 or 30, I'm also 30 deals. We're trying to pick them across all of the hot areas. Yeah. Not generally pile in one, unless I've announced my fund is only doing fusion.
Right. You have not set your fund scope to be too narrow.
My fund scope is anything that benefits from or drives the energy transition. Energy is the most important component of GDP. Therefore, anything that has GDP involvement is within my scope if I like it.
Right. It would be, my wife's a veterinarian, so I tend to think about the animal.
My dad's a veterinarian.
Yes, that's right. But it would be like
That's
if
not
I
why
set
Andrew's up here, by the way. He's up here because he's with Goose Capital and works under the stairs.
I also love animals. But it'd be like if you set up a fund that was specifically for investing into animal health or the pet industry, and there was a canine COVID and nobody wanted to have dogs anymore or something.
Well,
and that your whole fund is around something that just cratered. So you don't want to set your scope to be too narrow. You want to do healthcare in general
But you do set a scope, right?
Yeah.
We launch the fund, we set a scope. Now that scope may be broad, it may have some flexibility in it, but it's a scope and we're going to take those bets, those deal sizes, those scopes, those sectors in the next 48 to 60 months. That's what's going to happen. And if I can't get it deployed, I have a problem. I'm probably not going to change up my whole strategy because that will annoy my customer. That's like saying, hey, yeah, I'm going to sell you a watch, and I went and delivered them a toaster. They're like, no, I bought a watch from you, where's my watch? So big changes in that thesis aren't likely to happen. When I tell you this is what I do, for this fund, that's what I do. I may have 3 or 4 funds run by the same management company, each of them with different theses, but that fund is placing bets in its thesis and only its thesis.
Right. So I kind of want to come back to every round is kind of valuation and terms. Allocation also matters, as we've kind of already covered that. It matters. Well, let's come back to that too. I don't know if we killed that enough because it really matters. Okay, you're letting us into your deal. We think you're the winning company, but you're only giving us a $500,000 allocation on a $2 million round.
Go pound sand. I don't do that. I have zero interest in putting $500,000 in a big round. I got so little piece of the company. Yeah, it's like, what am I going to do with that? I cannot make the fund off that. It's like marketing collateral for me. You're cool. You're going to get some big rounds. You're going to make me look smart. And then they'll find out, oh, you have no real piece of the company.
Yeah, it's all marketing and PR. Like, if you 10x'd for Neil his $500,000, you give him $5 million back. He's a $50 million fund. Okay. Does he get to play the game again?
Now, on our little prototypical 50, that gets us 1/10, not 1x or 2 or 3x. That screws out my portfolio construction. So could I do it? Sure. Am I going to? Probably only if I plan on putting some more money into the next rounds to get a big enough percentage so that I can make my fund. Every deal has got to be a fund maker.
So you dip a toe into an earlier stage in a company for a bigger bite of the apple. In the next stage, you show your value, which is great.
Yes.
But what happens if you don't get to lead the next round or you don't win?
Creates a bit of perverse incentive because now I want that next round to be low. If I got a big piece in the beginning, I want that next round to be high, right? So we're going to have to invest in the next round because that's kind of how the world works. We share risk over successive rounds. So what you do to set up my deal, both valuation, percentage, who else is in, who's leading, who's on the board early, is going to affect you in the next round, and it's going to affect me in the next round.
Pro rata rights, super pro rata rights. Now, and we're also touching on something, self-led valuation increases. So you let somebody lead your seed round, and you're letting them lead your Series A, and then you're letting them lead your Series B, and it's all one kind of biased party. That's how you get companies take meteoric rises in valuation.
It's best if another fund comes in and sets the price. But to be honest, I know what I think my companies are worth. And there's plenty of times where you're not going to get into my deal for less than I think it's worth. I'll just lead it or fund it myself. That happens, and that's kosher.
Question for you. We'll get into the standard securities. You've led a preferred equity round, a Series A. Who gets to decide if the Series B offer is good enough?
So that's interesting, right? So I don't control the company. I might control the board. We might have a split board.
Did you put protective provisions in there?
We do, but CEO's job is to go sell that deal. But if I send the CEO out to sell the deal and I don't tell him that I'm going to back his play, and I don't tell him I'm going to come into the deal, and I don't get on the phone with the investors he's talking to and make damn sure they know you come in with a low ball, I'm going to slap you down and I'm just going to do it myself. I can get my deals done. Then who knows what'll come back? So CEO's supposed to sell it, but it's a partnership.
Unless you're the buyer of last resort, you are not going to say no because they've run their process, they've gone to market. The alternatives are to not take the money.
Or we can do an inside round, we can do a bridge, we can give you time. So one of the things that we're big on, and I think most good funds are, is what we call it a well-formed deal. Basically, I have zero interest in being in a cap table with people that don't know how to go run a cap table and help build a company. Because right when it matters, I'm gonna be like, all right, this company does not need to raise money right now. It's not quite ready. It needs a little bit more time. Let's all just pass the hat. We'll bridge it. Somebody says no. Like, what, I'm going to carry y'all now? You're going to put no money up, I'm going to put it up, I'm going to carry? I don't think so. I'll carry you at 1/10 of the price. Yeah, so we're very cautious about who we invest with, who we let come into our deals, and what portion they have. If I've got an investor in and it's Goose and you got 1% of the company, I know you can't spend any time on it. You're not going to be there for us the next time. So if I want you to play well with me and with my founders, I want 20, I want you to have 10. I want you enough so we can partner together, even if I'm the larger share.
And it's a two-way street. Who you let be investors in your company matters. We always look at the cap table. We want to know who set the last round price and terms.
First
we often
call.
see off-market terms and deals, and we're like, well, we're going to fix that. That's
First question, if I'm interested in your company, who owns it, who's on the board, what's your cap table? Yeah, my partner tells me, well, yeah, we get all excited, really great pitch, like the team, like the area, know it cold. Great, send me the data room. 30 minutes later, I'm moaning, whining, mad. He's like, look, I don't even bother to, I don't bother to go talk about the deal until you've seen the data room, because I know there's going to be some bodies buried, just a matter of how many of them. Right? Yeah, so you can hide stuff from us, not a problem. But an investor knows what they're doing.
Yeah.
They're going to ask those questions and find it out early. So you got to get it constructed so that it works for our incentives. Not now. This round does not matter, right? The next round is because every deal we do, I am looking at how much money do I have to carry in reserves, which is a function of who else do you have on that deal. Is the next round, can we get it off at a price and a deal that's going to be good for the next investor, or am I going to have to carry all that ball? Because that affects the deal. So my economic incentives on trying to make my fund and get my portfolio construction and all, it matters to you because it completely changes what I do, you do, and the next investor does in the next round. So if you don't know how I make money on your deal, you're going to be in trouble.
This is ultra important. I just want to repeat what Neil covered. We're thinking about the next round. We're investing in you because you're not just going to take $5 million and be done. You've got to then go out and raise $10 million, $20 million. What are your company's KPIs, your key performance indicator? What are your milestones you have to reach? If that round you're raising from us is going to last you 18 to 24 months, what do you have to do in that year and a half or 2 years to get to the next round? Meaning, and you took our money at a certain valuation, meaning what do you have to grow your company to in value? Do you have to get X number of revenue increase? Are you deep tech and pre-revenue product? Do you have to develop some sort of technical milestones to raise that next round? So when we invest in you, we want to know somebody like BP Ventures is going to be interested in you next. That's it. If you're not thinking about that, then you're not probably going to win over the VC. It's about the long game all the way to exit. So you kind of have to have the vision of where we're going to go, knowing that there's uncertainty in that vision, but being able to pitch it. There's a lot of storytelling in pre-seed and seed stage. As you get to A and B, you kind of start to have to perform. The story doesn't match anymore if you're suddenly a $40 million company and you have no revenue and your product hasn't been developed hardly at all, whichever sector you're in.
We're going to go through a lot of this next week in
yeah.
how to raise money as a first-time founder, how to game the VC. It's got a whole process, the pre-marketing, all this stuff. But the reason we're doing this talk first is because a lot of that is a function of how the VC makes money, what my customer wants, what my economic incentives are, right? Yeah, just getting the money back for the fund doesn't do me any good. My profit comes in the 20% profit. I need you to return the fund. Yeah, it's okay for me to lose all my money in your deal as long as one of y'all returns my fund and a couple more make my profit.
You're investing in companies typically with a pre-money valuation in the 10 to 20 million. I don't want to anchor you guys on this, but let's just think about.
Market sets the price.
Right.
Right. And unfortunately, over the last couple of years, we call it the dispersion of valuations is so all over the map. But let's go back to what we said earlier. Every single round, you basically sell 20 to 33%, something on that order,
Yeah.
plus or minus a little. So if you're raising 5, right, that means it's probably like a 20 post, 15 pre.
Right.
Yeah.
And
If
so
you're,
in that company, are you interested if they're like, we're going to be a $100 million exit?
that's a 5x on an early stage deal. I don't think so. So my
That's
5
only
turns
if they
into
don't require
25, I
any more
can't
money.
return the fund.
Yeah, exactly.
So I need you to be worth enough, which means I need your upside to be worth enough. So the things that square this circle, how big's your market and how fast is your growth? Those cure all else.
So in energy, when we were elephant hunting for oil and gas fields, there's a lot of similarities. We're talking about the P1 outcome on a distribution. What is the maximum you can be? If you're not, if you're not chasing $1 billion market, you're probably not going to be $1 billion company. But if your P1 is 100 million, that means your most likely outcome is like 15 to 20 million, a 1x if you don't raise any more money, which you probably will. You don't do well. So your P1 needs to be some very large, at the very large end range of uncertainty for it to be worth it, because we know we're going to get a lot of outcomes in between. We'd be perfectly happy if a company exited for 500 million.
Let's move on to the
billion.
decision-making process, because I think this is really the most important thing in the venture fund, is how do we actually think and make money? So structurally, right, there's usually an investment committee of some sort or other. In venture funds, it is almost always made up of working partners, i.e. everybody who has a vote, and it's kind of a soft vote, is running deals. We each run our own deals. We partner with each other on our deals. Some firms, man, you eat your own killing. You don't share. It's dog eat dog cutthroat. Some of them, ours is a bit more consensus. We team a lot.
Are you guys unanimous, or are you allowed a veto, or how's the?
So ours, majority rules.
Okay.
But
You have 3, right?
we have 3 of us.
Yeah, so you
But,
can do that.
you know-
Don't do odd number board seats either. Okay, go back. Don't do even number, excuse me.
We're majority, and a lot of funds are majority. Some are unanimous. Some are basically any partner can get it done. But in reality, if one of my partners really wants to do your deal, am I really going to balk him? No, we're partners. His job is to make us all money. So I'll tell him, I do not like this. But there are times when I'll say, I'm voting yes because I believe in you, my partner, and we're sharing risk here.
Right. They're going to have strikeouts. You know that.
Right. So it's okay for those decision processes to be a little murky. Now, but you got to be careful. Some funds you go to, and there's somebody at the top above making all the decisions. So there's a committee or there's partners, but there's really only one person making the calls, and you better know what that person thinks, because it don't matter what your partner does, that person will jerk the wool out from under you. Yeah, so you got to know what kind of decision process you're working on. And the funds won't tell you this part. They might tell you their process. They won't tell you the personalities. But I know there's some funds that, if we're going to do business with, only if so-and-so's on board. Because I need them to bring their fund along the next time. I don't want to have a daisy chain risk, right?
Can you explain that one a little more?
I got a person, they're on my board, they're making the decision, we're working on the company. They got to go report up 1 or 2 levels.
Yeah.
And so they say, yes, I'm in, or maybe, and they got to go get buy-in. And great. My partners want to get money out of us for the follow-on. Yeah, they got to come and convince me we're going to do it. We got to talk about it. So you got to bring your own firm along, right? That's important. So I need to know that those people can bring it along, and you need to understand the decision process so you can know they can bring their own firm along. And remember, it's usually working partners. Now in a CVC, like our BFFs at BP, who happen to be the only corporate venture who actually shows up in the ION on a regular basis, right upstairs, that process is not quite the same, right? So, and every CVC is organized differently. Andrew's process, he's an angel network.
Yep.
It's different.
We have investment meetings roughly every month. We have a lead investor, Goose member. You can think of, they're a member, they're kind of like an LP. They lead the deal. They believe in you. They're probably going to join your board and write the biggest check into the deal.
So you got to treat Andrew and me and Grace different, because our internal decision process is different. You got to respect that.
Yep.
Right? Well, our money's the same, but the processes aren't. Now, And you're right, some of these are consensus, some of them is majority, some of them, it's partner wants to do a deal, partner does the deal. Some of them it's all equal, except some people are more equal than others, kind of a George Orwell kind of thing going on.
Should we segue from the kind of the partner decision making or IC decision making process into kind of backable founders and the team?
I think first we need to explain what the titles mean. This is my favorite
Yes.
part of the talk. Okay, all right. There's an org chart in venture funds. And it's not quite what you think, and it doesn't mean what you think, and some of them are designed to obfuscate. Okay? There are firms out there that call everybody partner just to confuse you, and they put it on their little business cards. Kleiner Perkins started doing that way back in the day. I think they thought it was funny in the dot-com boom. I don't know. Yeah, then everybody copied because Kleiner was a big name, right? So there's usually people who own the firm, maybe managing partner, maybe it says founder, owner. Sometimes they'll tell you, sometimes they won't. Yeah? Remember, the firm gets carry, that 20% of the profits off the whole pool, that gets divvied up. Who owns most of the carry is basically who owns the firm. That's where the key economics lie, right? So then there'll be managing partners, managing directors, managing member, a lot of titles that basically mean I'm one of that kind of core decision-making partnership, okay? Second tier of titles. Director, VP, principal, what else? Guys, what else do people use? What's, CFO, well, we get to CFO in a second. Those people don't count. I've been a CFO, but for the fund decision structure, they don't count. So there's a tier of I'm not a partner, meaning I'm probably not in the investment committee on the decision process, but I can run deals, right? So our partnership says, yeah, principal, vice president, our organization, you can come run a deal. You can propose it to the partnership, you can lead it, we'll let you sit on board. You're senior enough, right? Great. So take tier 2, bunch of different titles say that. Then, associate, analyst, pick your other favorite, it's a staff. Deal running staff, but they don't run deals. Some funds, an associate will run a deal. Yeah, some funds they won't. So you got this is your hierarchy, right? So then there are venture partners and EIRs. These are very, very important people. They're very smart people. They tend to be very senior people, former CEOs, portfolio people, generally great resumes, and they are lower than the analyst because they can't do jack because they're not deal runners. But they may have significant influence. EIR is usually someone that's gotten hired by a fund basically to go hunt for a deal. He's supposed to join or she's supposed to join that deal. Venture partner is usually someone that's like, oh my God, I need this person on my team. I am not going to give them carry. But I got to have them involved. They're not part of my process, but I will pay them to be here because they are awesome. They may be a deal runner, they may not. Then CFO, admin, whole bunch of other staff decisions completely divorced from the investment process in most cases. So no venture fund people are bad. We're all really nice people, but we do have different roles. And you need to know who the hell you're talking to when you're having the conversation. Don't pitch your deal to a CFO, right? It doesn't make any sense. All they're really going to do is, hey, well, let me go get you one of the other guys.
But a warm connection is a warm connection. Pitching to an analyst is great, especially if they believe in you and they love your idea, because they've seen plenty of deals. They probably think it's good for a reason. That's my opinion.
We just like to change our title every quarter or two just for fun. I actually pay my partner, Craig, $1 extra a year to do all the administrative stuff, and I call him the administrative partner. Then he donates the dollar back to the firm, so we don't have to worry about the accounting on it. That's actually true. I make him do all the administrative stuff.
Where do you want to go from here?
I think we should go with some questions. See if, they're still here, so that's a good sign, but maybe because they can't get off the stairs without being noticed.
Yeah, I am game for questions.
How much time do we have before y'all's beers start?
Whenever, yeah. Call it 10 minutes. Nobody
Oh, 10 minutes?
Yeah,
All right.
5 o'clock.
5 o'clock. All right.
That's beer
Questions for Andrew?
Yeah, it's kind of the down round is when you're issuing equity at a share price lower than the last round, and it basically means you couldn't. Yeah, you could. You're at a lower valuation most likely, so you couldn't go out. It depends how much convertible securities you have stacked on it, but you couldn't go out and raise money at a higher valuation. The market, for whatever reason, basically said the people who invested in you last time may have been right at the time, but they're right no longer. Or the people who invested you last time got it completely wrong. You were never worth that much. That's why everybody's in the markets once you get out of, you have to be careful who you let set your price. It matters. I think there's a whole Silicon Valley episode like dedicated to the woes of somebody.
I think there's a South Park episode.
Probably. But, if you let a small dollar check or a,
Set your price?
yeah, of course, in the later stage, that's where they play. Okay. Neil, what are you doing?
Right here.
Yeah. we have a lot of companies that have a lot of the CVC and energy investors lead the deals. Anyways, does that answer your question about what the down round is? The market is saying, well, we'll give you more money to stay afloat because you're not cash flow positive or neutral or positive, but we want to do it. The last mark you had was $50 million. We'll give you $5 million at some much lower valuation. So it's an inevitable part of the cycle, and it happens. Usually, sometimes founders wait too long to realize they need to have a down round, and that's when companies go belly up. They scorn the only offers they get for down rounds, but the number one rule of finance is don't run out of money. That's it. Well, if you have a full ratchet, technically the calculation keeps spiraling down, and the new investor says, no, I'm not going to play that game. Your full ratchet is crap. It's gone. You're going to take, you past investors, we're going to recap, you're going to be this. Founders, I want to keep you incentivized. You can't fund a management team that's going to have no skin in the game. So you're just going to dilute the crap out of previous investors and keep the company alive. It's a reset. But it needs to be a reset between you, the new lead in the down round, and the management team. If it's still the same, then it's the founders. If it's a new management team. Because usually when there's a down round, it's because there were problems in management, and the management didn't execute, or various other things. We've had maybe 3 portfolio companies where the original CEO founders have been replaced out of 29. And sometimes there are situations where this goes back to picking the right team. Sometimes, and you don't know, you back them because you believed in them. Let me be very clear. You made that bet. It just didn't work out for whatever reason, and there are many. Sometimes there are founder CEOs that they don't necessarily scale up their leadership ability with the company, or they don't want to. They're like, no, I was kind of a CTO type, and I'm good. Like, if you want to bring in the org is now 150, 200 people large, and I'm overwhelmed, I'm stressed by this, I don't want to do this anymore. Bring in a professional CEO, hire from elsewhere, and I'll take the CTO role like I always wanted. Being a CEO is hard. So, yeah.
I have a question on getting an anchor. So this is Lana here.
Hi.
So during my last raise, we had a lot of investors who said, hey, we would invest in you, but we need somebody to anchor or to be
They're
first.
lying.
And it was really, really difficult.
Don't talk to anymore. They're lying. No, I'm serious. Look, there are 2 types of investors in a round. Someone who's going to issue you a term sheet and somebody who's not. And the only people you want to talk to is someone who's going to issue you a term sheet. So if you're talking to somebody and you go and pitch them, you need to know before you start, are they interested in leading rounds? And if they are a company that leads rounds and they're saying, I'm not going to lead yours, but I might come in to follow somebody else, something is wrong with your deal. If they're an investor who says, look, I don't lead deals, I just follow, and I'm a $2 million check. Or every once in a while, I'll tell you, look, I like what you're doing, but I don't know this area. I can't lead. Yeah, maybe in that case, when I say interested for some money, depending on the lead, I'm not lying to you. But most of the time when I tell you that, it's like, really, this just isn't a good deal, fix your deal. Or if I'm telling you contingent on, well, it's contingent on who it is, the price, and the terms. You don't assume I'm in. Yeah, you haven't sold me anything yet.
I think what you're hitting on is very important around, what you ran into is somebody who wanted to write you a check. They were probably what we call a soft circle for a follow in the round. They're basically like, let's say, like Neil said, you're raising $1 million seed, and they're like, well, we're only 50,000. If they're smart, they're not going to give you the 50,000 until you meet your minimum raise requirement. Meaning, let's say you're raising 2 million. The lead is willing to issue a term sheet. We'll do first close. You need to close with a minimum $1 million. Because why would I give you 500,000 if you're clearly not going to hit your goals and KPIs? Meaning you need 2 million for 2 years. I give you 500,000, you get 6 months. You just spent 4 months raising that 500,000. You are going to spend 4 to 6 more months raising the next 500,000. It takes a lot of time to fundraise. You're basically taking money, when it's undersubscribed, you're taking money and burning it in a barrel. So there are two types of deals, undersubscribed and oversubscribed. Undersubscription is risk.
What's the deal where you take the planes and you fly them off the dock into the water, see how far they go?
Like with you in it?
Yeah, that's what happens if you're not get the deal closed, right? The safe is supposed to fix that, and it does fix some, but it's got to be priced and structured to where it works. And those aren't lead investors. That's just filling out a safe is very different than raising a priced round. So you shouldn't treat them the same way. If somebody's interested in, if they do safes, if they're doing seeds, and like, great, okay, $1 million safe, open it up. Here's the terms, in or out, tell me now. You're putting in 50 or 100K. There's no diligence. There's nothing to do. It's 100K in a company that has nothing but you guys and an idea and maybe a piece of a patent or a prototype made somewhere. I just take a bet. That's a different process than if I'm raising a price round where I need a lead and I need people to follow. Generally, you don't worry about who's going to follow until you got a lead. It's most valuable asset in a startup is a term sheet. Always. Once you got a term sheet, you can always get it filled unless it is with a bad lead that doesn't know what they're doing. Yeah, unless it's a bad lead that doesn't know what they're doing, anytime you get a term sheet, you can get it filled out. If it's a bad lead who doesn't know what they're doing, it may be like, I'm not following them. They don't know what the hell they're doing. It may be like, that's a really dumb price or terms. Why did they give them that? And so you can sometimes get it filled out just with other people who don't know what they're doing. That's probably not a great idea, by the way.
It's the friends, families, and fools. Friends, families, and fools around is the joke about that early stage. And this goes back to self-priced rounds. We see entrepreneurs come to us with a self-price safe, like, hey, it's the first time we're raising money. We're going to raise on a 30 million post-money cap, and we've got an idea. Cool. There's nothing behind it. There's no IP. There's no revenue. There's one founder. Maybe they are tackling a huge problem, but the risk is astronomical. And so the only way, you don't want to do that deal right then and there. You're like, please get further and come back to us in 6 to 12 months when you've hit these milestones or gotten a little further along in your ideation, because the risk is you undersubscribe the round, you give them money, and they burn. And you see that a lot with repeat founders. You don't mind burning other people's money.
Well, worse, I got the safe, right? And I'm opening it up. I'm going to raise some money into it. And so you come to me. Now, I'll do a safe. I don't mind the structure. I've done converts. I've done safes. We'll put one in, and then we'll leave the next round. But I'm a professional investor. My fund's job, all I do all day long is try and write a check into you guys. That's my incentive. Remember, I have to deploy my money. So I can't do much with 100K in a safe. And if you tell me I'm raising $1 million and it's got no cap, or it's got a $30 million cap, or great. What you're really saying is, I don't want to set the price yet. All right, not a problem. But me, when I touch your deal, trust me, I'll make 5 phone calls and I'll get it filled. So I'm not going to go give you money into a safe and then go create value and bid up my own price. What's in it for me? Why would I do that? I'm very happy maybe to just give you a priced round if we can agree on terms. But I got to be a little careful there. Now, there are some funds that will do that, and they have scout funds or like seed set-aside funds. And these are super cool and super dangerous. Because what they'll say is they'll say, oh, yeah, we just put $250,000 into SAFE. And you say, all right, well, Energy Transition Ventures or XYZ Awesome Fund or BP Ventures, who's really big, by the way, much bigger than me. Great, y'all gonna give me $250,000. Why won't you give me the $3 million to lead the round? Well, I don't really believe that. It's kind of a flyer. So all right, so you take BP's $250,000, you take my $250,000, you take Andrew's $250,000, go to the next investor with $750,000 on $1 million safe at pick your favorite cap, whatever, it doesn't really matter at this point. And the next investor comes in, they take one look and they say, well, BP's got a lot of money. They're not completely stupid. Andrew and Goose got a lot of money. They're not completely stupid. Neil's got a little bit of money. He might be stupid, but he's in the business of leading these rounds. Why didn't he lead the round? And you create your own signal risk.
Expand on signal risk is kind of we're at 5:02.
We're almost at beer time.
Yeah, but expand on signal risk, because I don't think we covered it.
Chris has already left to go pay for the beers.
Very good.
Signal risk is when you let people into your deal and they're working with you, but they're not behaving like they should behave, and the next investors take a look and say, yeah, there's something off, because if this was a good deal, BP's already led the next round. ETV led the first round, BP joined them. BP's in the business of leading the next round. Why didn't they lead it? Well, sometimes there's a good reason, usually not. Because usually, if we're happy with the company, I call Chad, I call Grace, I'm like, look, this is the price we're gonna do the deal at. We're not gonna do it for less. Y'all wanna lead it? You want me to take it to market, which will get it bid up? You wanna be a stock in, and yeah, we'll bring other people in, but there's kind of a managed process. And we all know that. So if the process is just kind of being hung out there, we know that too. And like, well, for some reason, BP won't do that, or ETV won't do that, or Andrew won't do that. And it may be because Andrew's annoying and we're mad at Andrew. But that's also a deal problem. It may be because BP's decided to go another direction and they were supposed to be a big customer. It may be because my partnership lost the thesis. We don't like that area anymore, or we don't like the founder, and we're just trying to dump that on the next guy. But usually our good ones, we're all willing to help them keep going. And so you as a founder got to realize not only which fund you take the money from, but which type. I had one deal we looked at, and I'm like, oh, this is cool. These are cool people in here. It was exactly this. It was safe. They were raising $1.2 million, and I'm like, I'm not going to do that. I'll price the deal. I'll give you 2. And I'll price it. And I don't remember what the price we'd agreed we were asking for, and they had a 20 million cap on that safe. It was one of them Y Combinator specials. And I'm like, I'm not gonna put in 2 million on a 20 cap. That doesn't do me any good. I wanna price the round. Now the round may end up coming in much lower than that, but I know once I touch it, I'm gonna impact it, like that Schrodinger's cat thing. Yeah, and so I'm like, look, you got like 2 people in this little safe that are in for $250,000. These are good funds. They're smart as me. They're smarter. Just call them and tell them you got a guy who will split $2 million with them. Just pick one. Kick the rest out. We and they will do $1 million each. He's like, oh, I can't do that. Why not? Well, they won't go to $1 million. They're a $200 million fund. Why the hell will they not go to $1 million? Oh, I don't know. Well, the answer is because they're treating him like a free option. And so I'm like, okay, so these people are literally just using signal risk as a weapon to throw it out there, to queue up the next deal. Because we all know they got to come back to those guys and do a deal with them or create signal risk. It's like, could not convince the entrepreneur of this. Could not convince him, lost the deal.
To me, this comes back to, self-pricing rounds and letting small checks set the price and terms, and then the deal sits there undersubscribed. We know that. We see that, and it's not good. So,
One more question.
yeah.
So we actually had like 3 or 4 people that had more questions. So do you want to take them in second draft, or do you want to how do you want to do that?
Chad and Grace are going to take them in second draft? Raise your hand, wave. These are the guys buying the beers, and they write checks bigger than my checks, so they're going to help us take them in second draft. How's that, Christine? Will that work?
Works for me.
One more?
Okay.
Hey, thanks, guys. Quick question. Neil, you mentioned that you tend to not overlap investments in certain verticals. You kind of want to pick more of a winner in certain macros and stick with that. But I do know that other funds like BP and some of the larger institutional funds will kind of spread the wealth and take multiple bets in different verticals. How would you all advise founders to approach different VCs and do their homework on the front end so they don't spend so much time chasing down investors that may already be solid in their, competitor or rival firms?
Just ask. I'll tell you. I'll straight up tell you, look, I like what you're doing. I'm unlikely to do another one in that sector. Or I lost money on that area and I'm jaded. Or, what, we've kind of filled our allocation to that. Or I'll tell you, you know what, I like EVs and I'm looking for more EV deals to do. Listen, when I tell you stuff in the call, I like to hear myself talk. That's part of it. Let's be clear.
Yep.
But I'm usually telling it to you for a reason. And if I say it twice, it's because you didn't listen, and I'm trying to signal, hey, not trying to be a complete jerk, but we're not on target here. So yeah, when you say, hey, I'm doing an EV deal, are you interested in it? Usually I'll tell you, yeah, I'm interested in EV deals. If I ask for your deck, I'm generally interested enough to talk to you. If I set up a call with you, I'm interested enough to hear it. If I set up a call with my partners, I think you're interesting enough for them to hear, but I don't have conviction to go tell them we're going to go do this deal yet. So you got to go upsell them, right? That's kind of the way it works.
Just to close on that, we're just each of us one opinion. But, you hear it, go, trust but verify. Go get a second opinion, a third opinion, see if there's a pattern. So thank you all for coming out.
So BP has an open tab right up there. Walk up and see how much of their beer you can drink and meet them. And thank them very much for helping sponsor it. And frankly, thank them for being in the building and actually here writing checks. Same with Andrew. This place is useless as a building unless there's people writing checks and founders in it. That's why we're doing the whole event and the beers. All right, let's drink.